If you've spent any time in a Canadian investing subreddit, you've seen this fight. XEQT versus VEQT. Two funds, tens of billions of dollars combined, and investors arguing over a decision that, by the end of this video, you'll see barely moves the needle either way. Welcome to Wealth North, I'm Alex Morgan. If you're new here, we do evidence-based, no-hype Canadian investing content. No affiliate deals, no sponsorships driving the opinions you're about to hear. If that's your kind of channel, consider subscribing and stick around to the end. Because the actual verdict on these two funds isn't what most comparison videos tell you. I'm going to show you the actual numbers. Fees, holdings, performance, and the one factor that matters more than either ticker. Let's start with what these actually are. XEQT and VEQT are both one ticket, all-in-one equity ETFs. You buy a single fund, and inside it you own thousands of stocks. Canadian, US, international, developed markets, and emerging markets, all in one package that rebalances itself automatically. XEQT is BlackRock's iShares Core Equity ETF portfolio. VEQT is Vanguard's equivalent, both launched in 2019. Both are designed for investors with long time horizons, think 15 years or more, who want maximum growth potential and can stomach the volatility that comes with being 100% in stocks, no bonds at all. Both trade on the TSX. Both are commission-free on Wealthsimple Trade and several other Canadian brokerages. If you're building a one-fund portfolio for a TFSA or RRSP, these are almost certainly the two funds you're choosing between. So the real question isn't which one is good. They're both excellent. The question is which specific differences actually matter for your money. Let's go through them one at a time. First, fees. This is where the story changed in the last year, and a lot of comparison videos haven't caught up. For years, the standard line was XEQT is cheaper. That used to be true. But in late 2025, both issuers cut their fees. iShares dropped XEQT's management fee to 0.17%. Then Vanguard matched it, cutting VEQT's management fee from 0.22% all the way down to 0.17% as well. As of today, they're essentially tied on the underlying management fee. The published MERY, which includes some additional costs, currently sits a touch higher for XEQT, around 0.20% versus VEQT closer to 0.17%. That gap will likely narrow further as both funds report new fiscal year numbers. Let's put this in real dollars. On a $100,000 portfolio, a 0.03 to 0.04% difference in fees is roughly $30 to $40 a year. That's less than the cost of one trading commission on some platforms. If you picked XEQT because it used to be cheaper, that reason no longer holds up the way it did 2 years ago. Fees, basically a wash, moving on. Now the part that actually creates a real difference. What's inside each fund? Both XEQT and VEQT hold roughly 45% in U.S. equities. That gap has closed over time, too. Where they diverge is everywhere else. VEQT holds more Canada, about 30% of the portfolio, versus XEQT's roughly 25%. VEQT also holds slightly more emerging markets, around 7%, versus XEQT's 5%. XEQT, in turn, holds more developed international markets, Europe, Japan, and similar, at around 25% compared to VEQT's 18%. So here's the actual trade-off. More Canada, like VEQT has, means more familiar companies, no currency conversion drag on dividends, and some tax credit benefits outside registered accounts. But Canada is only about 3% of global stock markets. So a 30% weighting is a significant home country bias relative to the global market. XEQT's tilt toward developed international markets gives you more exposure outside North America, which some investors prefer for diversification, at the cost of slightly less home bias. Neither of these is objectively better. It depends on how much Canada risk you're comfortable carrying, and whether you value diversification breadth or familiarity more. One more small practical detail. Unit price. XEQT trades around $46 a unit. VEQT around $62. If you're investing smaller amounts and your brokerage doesn't support fractional shares, the cheaper XEQT unit gets you closer to fully invested with less leftover cash sitting idle. Now, the number everyone actually wants: performance. In calendar year 2025, XEQT and VEQT returned an identical 20.45%, matched to the basis point. That's not a coincidence. When two funds hold overlapping global exposure and nearly the same U.S. weighting, the year-to-year performance gap tends to be small and can flip direction depending on whether Canada, international, or emerging markets happen to outperform the U.S. in any given year. Neither fund consistently beats the other. Some years VEQT edges ahead because of its Canada tilt. Other years XEQT edges ahead because of its international tilt. Over a full market cycle, these differences tend to wash out. One more operational detail worth knowing. Both funds currently pay distributions quarterly, so income timing isn't a differentiator, the way it might be with some other ETF pairs. If your entire decision is which one will perform better, I'd stop you right there. Nobody can reliably predict that in advance, and the historical data doesn't show a durable edge either way. So, XEQT or VEQT? Here's my honest take. For most Canadian investors, this is close enough to a coin flip that optimizing between them is not where your time is best spent. Pick XEQT if you want the marginally lower published MER today and a lower unit price for smaller contributions. Pick VEQT if you want more Canadian content, useful for dividend tax credits outside a registered account, and you're comfortable with a bit more home country concentration. What actually moves the needle far more than this choice? Whether you're holding the fund in a TFSA or RRSP versus a non-registered account, because these all-equity funds distribute foreign income that gets taxed at your full marginal rate outside registered accounts. And frankly, whether you're actually contributing consistently. An hour spent agonizing over XEQT versus VEQT matters a lot less than automating a monthly contribution and leaving it alone for a decade. Pick one. Don't hold both. You're not adding diversification, just complexity. To recap, fees are basically tied now that both issuers cut them in late 2025. Holdings differ mainly in how much Canada and how much international you're carrying. Performance has been essentially identical. And the bigger lever is account type and consistency, not ticker choice. If you found this useful, the next video in this series tackles VGRO versus XGRO, the balanced 80-20 version of this exact same debate, which is what a lot of you asked about after the XIC versus XEI video. Subscribe if you want more of these straight, no affiliate comparisons. I don't get paid to recommend either of these funds, which is exactly why I can tell you they're both fine choices. I'm Alex Morgan, this is Wealth North. See you in the next one.